The screen says $114.47 per ounce. That's the spot price for silver this morning, January 28th, 2026, a 58.6% gain in a single month. And while you were sleeping, it briefly touched $115. I'm going to be direct with you. I've spent over a decade trading commodities, most of that time with skin in the game and physical silver. I built this channel because the information landscape has become polluted with AI avatar channels pumping out garbage, and the credible sources are always 12 to 24 hours behind the data. So I use this format to get you the information faster than I could edit and record traditionally. That's the only reason you're looking at an avatar instead of my face. Right now, CNBC is screaming bubble. Bloomberg is running segments on Silver Squeeze 2.0. The financial media wants you to believe this is a repeat of 2021. A flash in the pan driven by retail mania that will collapse within weeks. But here's what they're not telling you. The price isn't rising because people are buying. It's rising because the institutions have run out of things to sell. And the one thing they're absolutely refusing to mention involves a secret prepayment deal by a major tech manufacturer that just rewrote the playbook for how industrial silver gets acquired. We'll get to that. Let me lay out my thesis clearly. Silver is not in a bubble. What we're witnessing is a strategic revaluation. The death rattle of the paper pricing system as industrial giants bypass the exchanges entirely and lock up physical mines directly. The mechanism driving this is called backwardation, and it's the market's internal fire alarm. Today, I'm going to walk you through the mechanics of this supply chain lockup. I'm going to run the math on the 16-to-1 paper-to-physical ratio that makes a squeeze mathematically inevitable, and I'll share my personal conditional battle plan for navigating this $114 silver environment. This isn't hype, this is math. And the math is terrifying if you're on the wrong side of it. Let's start with the numbers I was looking at a few hours ago. Silver spot price, $114.47 per ounce, up 58.6% this month alone. That's not a typo, that's not a glitch. That's a market that's fundamentally broken. COMEX registered silver stocks, the physical metal available for delivery against futures contracts, have shriveled to 30 million ounces. To put that in perspective, that's the lowest level we've seen in over 2 decades. The warehouse is nearly empty. On January 1st, China implemented export restrictions on silver refining. The world's largest silver refiner essentially closed its gates to everyone except state-approved firms. This isn't a trade skirmish, this is a strategic resource lock. And here's where it gets interesting. The spot price in London is $114, but if you want physical silver delivered to Shanghai, you're paying the equivalent of $128 per ounce. That's a 12% premium. Think about what that spread means. Money is flowing east because that's where the metal actually exists. The paper price in London is $114, but if you want it in your hand in Shanghai, it's $128. That gap is a ticking time bomb. Now, I need to explain the concept that's driving this entire situation. It's called backwardation, and if you understand this, you understand why the current price action is not speculative euphoria, it's industrial panic. In a normal, healthy commodities market, futures contracts are more expensive than the spot price. This is called contango. It makes sense, right? If you're buying something for delivery 3 months from now, you're paying for storage, insurance, and the time value of money. The future price should be higher than today's price. Backwardation is the opposite. It's when the right now price is higher than the future price. Let's pull this apart with an analogy. Imagine you're stranded on the side of the road. Your car's dead. You need a vehicle immediately to get to a critical meeting. You walk to a car dealership. There's a used car on the lot for $50,000. The salesman tells you he can order you a brand new model for $40,000, but it won't arrive for 3 months. Which one do you buy? You buy the $50,000 used car sitting on the lot, not because it's a better deal, but because you need it now. You can't wait 3 months. That's backwardation. It's a physical scramble. It's desperation masquerading as market pricing. In the silver market right now, industrial users, solar panel manufacturers, electric vehicle producers, electronics companies, are terrified of factory shutdowns. They need the atoms, not the paper contracts. So they're outbidding traders for immediate physical delivery. They're paying a premium for right now because 3 months from now doesn't keep their production lines running. Stop. Look at the price chart from the last 30 days. That vertical line isn't greed, it's desperation. But the industrial panic is nothing compared to the math the bullion banks are currently facing. Let me show you the numbers that should keep every precious metals desk at a major bank awake at night. The March 2026 open interest on COMEX silver futures represents 500 million ounces of silver. That's the notional amount of metal that's theoretically supposed to be deliverable against those contracts. There are 30 million ounces in the COMEX registered vaults, 30 million available to satisfy 500 million ounces of potential delivery demands. That's a 16-to-1 ratio. 16 ounces of paper claims for every 1 ounce of physical metal. Now, let's run a simple stress test. What happens if only 10% of those paper contract holders decide they want physical delivery instead of cash settlement? 10% of 500 million ounces is 50 million ounces. The vaults hold 30 million. The exchange is empty, mathematically empty. But here's the piece that changes everything. In late 2025, Samsung, one of the world's largest electronics manufacturers, paid a $7 million prepayment to Silver Storm Mining. This wasn't a futures contract. This wasn't a London Bullion Market Association transaction. This was a direct mine-to-manufacturer deal that completely bypassed the traditional exchange system. Think about what that means. When the biggest buyers stop using the exchange loses its ability to set the price. The paper market becomes irrelevant. So let me recap what we know at this point. Supply is restricted by China. Inventories are at 20-year lows. Industrial giants are panic buying mines directly. And the paper-to-physical ratio is 16-1. So why is everyone on financial television telling you to sell? Because they are terrified of what happens if you don't. Now, I know what the skeptics are saying. I've read the technical analysis reports. I've seen the commentary. So let me address it head on, because this is where most people get it wrong. The bear case goes like this. This is a blow-off top. Look at the shooting star candle pattern at $115. That's a rejection. Once the CME raises margin requirements, the Robinhood traders will get wiped out. This is 2021 all over again. Here's why that analysis is completely missing the point. Margin hikes only work when the buyers are speculators trading on leverage. You cannot margin call Samsung. You cannot margin call the Chinese government. They are not trading on margin. They are buying for survival. When a solar panel manufacturer locks up a mine, they're not doing it because they think the price is going up. They're doing it because if they don't secure the supply, their factories shut down. That's not speculation. That's operational necessity. The other argument I keep hearing is substitution. High prices will lead to substitution. Industries will just switch to alternatives. Let's be realistic. Solar panels can't just switch to copper overnight. The efficiency loss would be 20% or more. Electric vehicle manufacturers can't redesign their battery systems in 6 months. The industrial applications of silver are not easily replaceable. They want you to think this is a retail bubble, so you will give them your silver before the real squeeze starts. That's the game. Now, let's talk about what happens next. And I want to be very clear about separating verified information from rumors, because there's a lot of noise out there right now. There are unverified reports circulating about a potential force majeure clause being drafted in London. There's talk of a $390 billion short position bailout. I want to emphasize, these are unverified. I've not seen primary documentation. Treat them as rumor mill material until proven otherwise. What I am watching closely is institutional reaction. If this continues, expect media blackouts on silver's gains. Expect technical glitches on trading platforms at critical moments. We've seen this playbook before. Here's my personal dashboard, the metrics I'm tracking every single day. First, the gold to silver ratio. It's currently heading toward 40-1. Historically, when this ratio compresses, it signals major revaluation events in the silver market. Second, COMEX registered stocks. If that number drops below 20 million ounces, it's game over. The exchange cannot function at that level. Look at the wick on Monday's candle. The battle for $115 is the front line of a financial war. That's not technical analysis hyperbole. That's what the order flow is telling us. Now I want to share my personal battle plan. This is not advice. This is strictly what I am doing with my own capital. You need to make your own decisions based on your own risk tolerance and financial situation. Trigger A. If silver closes below $100 on a weekly basis, I'm liquidating 25% of my mining stocks. I will take my win and wait for the dust to settle. I'm not a hero. If the market breaks technical support that decisively, I'm reducing exposure. Trigger B. If March delivery notices exceed 100 million ounces, I'm staying away from new paper positions entirely. I do not want to be settled in paper cash when the metal is what matters. Physical delivery is the only thing that counts in a backwardation scenario. Trigger C. If we see a flash crash to $86, and I think this is possible if they try one more coordinated takedown, I am personally a buyer of physical bullion. To me, that's not a crash. That's a gift. That's a final liquidation event before the system breaks. But here's my core position. I am watching the registered inventory number like a hawk. If that number drops below 20 million ounces, I'm sitting on my hands and holding what I have. I'm not chasing. I'm not trading. I'm just holding physical metal and waiting. Because at that point, the paper market is functionally dead. Price discovery will shift entirely to the physical market, and that's where you want to be positioned. I've been in this market long enough to know that the most dangerous moments are when everyone agrees on the direction. Right now, financial media wants you to believe this is a bubble. They want you to think retail traders are driving this. They want you to sell. But the data tells a different story. The Samsung deal tells a different story. The Shanghai premium tells a different story. The backwardation tells a different story. The paper market for silver has operated on the assumption that physical delivery would always remain a small percentage of total open interest. That assumption is breaking. When industrial users bypass the exchange system entirely, when the world's largest refiner restricts exports, when registered inventory drops to levels that can't satisfy even 10% of outstanding contracts, that's not a bubble. That's a structural failure. I want to address something that I think gets lost in these discussions. People hear $114 and they think that's expensive. Silver was $18 just a few years ago. But that $18 price was an artificial construct maintained by unlimited paper supply. When physical metal was abundant, when Chinese refineries were exporting freely, when industrial buyers trusted the LBMA system, sure, $18 worked. But we're not in that world anymore. The physical world is reasserting itself over the digital. The atoms are mattering more than the contracts. And here's what keeps me up at night. If the COMEX cannot deliver against even a fraction of outstanding contracts, what happens? Do they change the rules? Do they force cash settlement? Do they halt trading? I don't know. And that uncertainty is exactly why I'm managing this position so carefully. Let me give you some perspective on how I'm thinking about time frames. The March contract is the critical one. Delivery notices start coming in next month. That's when we'll see if this 16-to-1 ratio actually gets tested. If industrial buyers stand for delivery in size, we'll know very quickly whether the system can handle it. If the system can't handle it, I expect circuit breakers, emergency rule changes, political intervention. This isn't just about silver. This is about the credibility of the entire commodities futures market structure. And that's why the Samsung deal is so important. It's a blueprint. It shows other industrial players that there's an alternative to the exchange system. Lock up mines directly, pay premiums, secure physical supply outside the paper market. If that becomes the standard practice, the COMEX becomes irrelevant. And if the COMEX becomes irrelevant, the price discovery mechanism shifts entirely. We could see a bifurcated market, one price for paper, one price for physical, and the spread between them would be the cost of reality. I've seen some analysts comparing this to the palladium squeeze of 2020. That's not a bad comparison. Palladium went from $600 to $3,000 because of a supply deficit and industrial panic buying. But palladium is a much smaller market than silver. The systemic implications here are larger. The other historical parallel people mention is the Hunt brothers in 1980. That was manipulation. This is different. This is industrial demand colliding with structural supply constraints. The Hunts were trying to corner the market for profit. Samsung is trying to secure supply for survival. Those are not the same thing. Well, what I'm watching for in the next 2 weeks is simple. Does registered inventory continue to decline? Do we see more mine-to-manufacturer deals announced? Does the Shanghai premium widen or narrow? If registered inventory drops, if more direct deals get announced, if the Shanghai premium widens, that confirms the thesis. The paper market is dying and the physical market is taking over. If registered inventory stabilizes, if the Shanghai premium narrows, if we don't see additional direct deals, then maybe the system has more capacity than I thought. Maybe this is just a volatility spike that gets absorbed. But based on what I'm seeing right now, I'm betting on the former, not the latter. Here's something else I want to mention. The retail premium on physical silver coins and bars has also exploded. American Silver Eagles are trading at $15 to $20 premiums over spot in some markets. That's unprecedented. That tells you that even at $114, there's a physical shortage at the retail level. So you have a shortage at the industrial level, a shortage at the retail level, and a paper market that's still pretending everything is fine. That disconnect cannot last. Now, I said earlier that I'd be sharing information you're getting 12 to 24 hours ahead of the mainstream financial press. Here's what I mean by that. I have access to Bloomberg terminal data, vault reports, and shipping manifests that the average investor doesn't see. When I see registered inventory numbers, I'm seeing them in real time. When financial media reports those numbers, it's usually a day later. That timing advantage matters in a market moving this fast. This morning's price action, the touch at $115, happened while most of the East Coast was still asleep. By the time CNBC started their coverage, the moment had passed. This is exactly why I built this channel. The information asymmetry in commodity markets is massive. Institutional players see the data in real time. Retail investors read about it the next day. I'm trying to close that gap. Let me also address the elephant in the room. Yes, I'm using an AI avatar. Yes, there are 100 other channels doing the same thing. Most of them are garbage. They're scraping news headlines, running them through a script generator, and pumping out content for ad revenue. That's not what this is. Every data point I've cited today is verified. Every number is current. Every analysis is based on primary sources. I'm using this format for speed, not because I don't have credibility. I have a decade of trading experience. I just don't have time to edit traditional videos when the market is moving like this. All right, let's bring this home. Where does this leave us? Silver is being sucked out of the system. The 16-to-1 paper-to-metal ratio is a mathematical certainty for a squeeze. The Samsung deal is the new blueprint for industrial survival. China has locked down exports. COMEX inventory is at 20-year lows. Backwardation is screaming that industrial users are panicking. The price on your screen is an illusion maintained by banks that are out of time. The real price is being set in the vaults of Shanghai, in the prepayment agreements between miners and manufacturers, in the physical market where metal actually changes hands. If you want to understand how we got to this point, you need to see the data on the 2025 supply deficit. I've done a deep analysis on that. I'll link it for you. It connects the dots between mining production declines, industrial demand growth, and the structural deficit that set up this entire situation. But here's my final thought. I don't know if silver hits $150 or crashes back to 86. I don't know if the COMEX changes the rules or if industrial buyers break the system entirely. What I do know is that the mechanics driving this market right now are fundamentally different from anything we've seen in decades. This isn't speculation. This is necessity. And when necessity drives price instead of sentiment, the moves are bigger and faster than anyone expects. So watch the registered inventory. Watch the delivery notices. Watch the Shanghai premium. Those are the real indicators. Everything else is noise. And remember, I'm sharing what I'm doing with my own money. You need to make your own decisions. But if you're in this market, stay sharp. The next few weeks are going to be wild.